All right. All right. Good evening, everybody. For those of you that don't know me, my name is Hema. I am active duty Army. And tonight, Troy and I have been hosting these underwriting calls every Thursday for the past, 4 or 5 months. And we just do a power hour of underwriting. Tonight, we have the pleasure of hosting Rob Beardsley. Before I introduce Rob and we get started, I want to just hit up a couple admin notes just for everybody that's here participating. First of all, welcome. Glad you were able to make it. We will be releasing a recording of this meeting probably within the next 24 hours via email. We're going to mute everybody through the Rob's discussion. That way we can focus the Q&A at the end for the last 20 minutes. But if you do have any questions throughout, just pop them in the chat box. Troy and I will be moderating and we'll bring those up there at the end. So with that, I'll go ahead and introduce our guests. Rob Beardsley, as you all know, oversees acquisitions and capital markets for Lone Star Capital. He has acquired over $100 million of multifamily real estate. He's also evaluated thousands of opportunities using proprietary underwriting models and published the #1 book in multifamily underwriting, The Definite Guide to Underwriting Multifamily Acquisitions, which I'm a fan of, and most of you also have it or have heard of it. So with that, Rob, welcome to our underwriting call. Thanks for being here.
Absolutely. Thank you so much for having me.
Awesome. Well, I gave you the shared screen, so let's get started there with some practice underwriting. And I see Eric Upchurch, welcome as well, and a few other folks as well in the call. But we're going to do a sample deal and then hit some of the topics. There you go.
Yeah. So before I jump right in, I want to kind of just gauge the audience. And so we're not doing something that everyone is already familiar with, or, just want to maximize the value. So, I'm happy to go kind of step by step from scratch, or we can, kind of take it to the next level and go a little more advanced. So let me know, or everybody kind of on the call, you can chat in or chime in and just, let us know if, what are we doing tonight? Should we focus on kind of just setting up the numbers, or should we focus on sensitivities and the waterfall and go more advanced?
I think definitely the next level graduate will be
Perfect.
where we're all
Everyone's saying next level.
Yep.
Awesome.
Next level it is, yeah.
Yes, perfect. So, and that's what I'd prefer to do anyway. So, yeah, so hopefully everyone can see my screen. This is a deal that I had actually recently used for a boot camp mastermind that I was teaching at over the weekend. So it was a deal that was brand new to me that I kind of underwrote on the spot in front of the audience, and it's a very large deal, interesting, not, kind of run of the mill opportunity where, as you can see in the unit mix, we have in-place rents, in-place rent premiums. So if you look at the one bedrooms, for example, that I highlighted in this gray, you've got classic units, and then a classic partial, and then a I forget what the D stands for, and then a premium, the P. So, and then obviously there's a different rent for each one. And so pretty straightforward way to underwrite that. The way that we typically look at that is we view those premium units as in-place comps, and then we bring rents. We assume we're going to renovate all the units to that finish. And then we also justify that with external comps by actually, performing comps, not just looking at in-place comps with the premium units versus the classic units at the property level. So that's kind of just setting the stage for what kind of deal this is. This is, again, pretty standard value add deal. Pretty light lift, actually. If you look at the rents, we're only increasing 7%. So not a big lift, but and funny enough, the deal actually sold for 114 million. And, I'm looking at the numbers, and I'd say just a little north of probably 100 is where it would get an IRR that would be acceptable to myself and most investors. So just fascinating to see how the market views deals, and especially with these bigger ones where the institutional capital has a lower cost of capital, that they're able to pay up and get the deal done. So, but with that being said, let's focus on the sensitivities, and just, whether these numbers are right or wrong doesn't really matter. Whether the price is 100 million or 114, let's just focus on what the sensitivities have to offer to us and what we can learn from the deal, from this tab about the deal. So starting with up here, this is truthfully not somewhere I spend a whole lot of time on in terms of, using my own spreadsheet, but nonetheless, I thought it would be helpful to just have these important main metrics all in one place, like the major assumptions. For example, it's good to know, the hot topics like rent growth, vacancy rates, hold period, cap rates, exit cap rates. So that those are all there. And then the return summary is there as well, of course. And looking at something that's a little more interesting is something like unlevered IRR, for example, which not very many people talk about unlevered IRR, but it's something that is a good way to gauge before you add on all the bells and whistles of debt, partnership structure. Do you have a good deal just at the core foundation? And a really good way to look at that is unlevered IRR. And in my opinion, an even better way to look at that is actually with the yield, the stabilized yield on cost metric. So I'm sure some of you on the call are already pretty familiar with that, but just to go over that really quickly, the stabilized yield on cost, or also the return on cost, like I said, it's something that we focus a ton on because it's even better than unlevered IRR because it doesn't even factor in the hypothetical sale, right? That's where a lot of us get into trouble in general when we're looking at deals, is we project a very aggressive sale price, and then kind of the deal banks on just the sale, right? It's like a marginal deal, and then you're just hoping that the sale bails you out and it turns into a good deal. And with the return on cost metric, you're really evaluating the return potential of the deal irrespective of the profits upon sale. All right. And so just to go over that this return on cost takes into account your future stabilized NOI, right? So it works perfect for value add deals where the going in cap rate isn't as important, because when we are when we're value adding, obviously we're adding income to the property, and then you divide that by your cost basis, which would be your purchase price and your capex budget plus any carrying costs. So if you have negative cash flow, and you have to actually have an interest reserve to cover that negative cash flow for a period, that would also factor into your basis or your return on cost calculation. So basically, you're building a future income, right? You might be buying an in-place income of 5%, 5% cap rate, but then you're pushing it through your capex budget or reduced expenses, what have you, to here in this case a 5.78 return on cost, which you can look at this deal and say, well, that's still pretty skinny. And you can see that what you want is you want a return on cost that is in excess of your exit cap rate. And that's where you actually create value, because if you can buy right and increase the income so that you have a return on cost that's, let's say, 6.5%, but then your exit cap rate is 5.5%. Now you've created that 1% spread there. And that's where you're able to actually justifiably sell and make a lot of money on that sale. But if the sale opportunity goes away because, let's say, the market isn't there, or debt gets more expensive, you're not tied to that projected sale, because you're happy with the yield that you've created, right? You've built a 6.5% unlevered yield, and then when you finance that at 3% or 3.5%, you're able to get double-digit cash-on-cash returns, and so you're okay if you aren't able to opportunistically execute on your sale. So yeah, so that was a quick tangent on the return on cost, but that's a super important metric. If that's something that you're not currently focusing on, start paying attention to it, and you can see the underwritten cap rate, and then what's your stabilized cap rate. Are you actually creating value, or is your capex not really doing that much in terms of creating value? So that idea also brings me to the Irr partition, which is kind of that idea where, are you creating more value from cash flow or from the sale? Which, it doesn't make the deal good or bad if it's one way or the other. It's just indicative of the deal profile and the risk profile. And so IRR as a calculation itself does a good job of factoring in the time value of money. So the cash flows coming from the sale down the road are discounted more substantially than cash flows coming from cash flow. So the IRR calculation already does that, but we as investors should do that even further and look at deals that produce the bulk of their returns from cash flow and be willing to accept a lower return. This is something that I think the market is not, or investors are not doing a good enough job of, which is actually adjusting their return hurdles down for deals that are more cash flow focused and lower risk. And so that's interesting, because the way I'm seeing it is some deals you can actually buy that don't have a ton of value add, but you can buy them at a slightly better cap rate. And so you're getting a pretty good risk adjusted return, but your absolute return is lower. And those deals, unfortunately, for whatever reason, are harder to convince investors, because the average investor, right, a high net worth doctor, lawyer, whoever, they look at their private real estate investing and think, well, this is kind of like illiquid, it's opportunistic. If I'm going to do this, I need a 20% return, or I need a 16% return. And so that is an interesting challenge, but it also presents an opportunity for those investors who are willing to play in that lower risk space and get, in my opinion, a better risk adjusted return. So here in this deal, for example, we are getting a substantial portion of the return, or the IRR, from sale, yet we aren't actually creating that much value. If you look at the revenue increase, and this is something that we focus on a lot when we look at deals, is this little number, which just looks at the increase of effective gross income from T12 to our stabilized. So when I look at something that we're only increasing revenue by 0 to 10%, I consider that low risk, and I call that core plus, right? Or light value add. If it's 10 to 20%, that's value add. If it's 20% plus, that's, real value add. That means real business plan execution needs to take place in order for your returns to come to fruition. Whereas in this deal, we're only banking on a 4.5% revenue increase to hit our returns. And so if that doesn't happen at all, if we go flat from T12 to stabilized, it's really not going to ruin the numbers. So that's just another indication of risk. But what I find really interesting about this deal, and I'm looking at this deal with fresh eyes, this isn't a deal that I've actually been studying, but the fact that we're both not raising revenue by a lot, yet still depending so much on the sale, tells me that our exit cap rate is probably more aggressive than you'd like, right? And so we're using a 5.25 exit cap rate. And this is a funky deal because, as you know, it sold for 114 million, right? So at my $100 million number, it's actually almost a 5.5 cap, which, you'd be stealing a deal if you could buy $100 million institutional deal like this in a strong market like Tampa for a 5.5 cap. Because in reality, at 114 million, they actually paid a 4.6 cap, right? So the market for that deal, I mean, really, in reality, a 5.25 cap rate is probably justifiable for this type of deal. So now if you look at the the Irr partition, now it's even more of the returns are betting on the sale. So, for me, that's just not a type of deal that I would be interested in, but it's just indicative of, as you buy, higher quality assets, better locations, right? You're forced to paying lower cap rates. And with lower cap rates, you obviously have less cash flow, and then you're just more reliant upon a capital event to earn your return, which here you could see, paying the full 114 price, they're still getting an 8% IRR, which presumably for an institutional investor is not, the end of the world. So, it's just interesting. But I think for the purposes of us evaluating this deal, it's more interesting to look at $100 million price, because then we get more of a mid-teens return, and we can actually look at the sensitivities and look at the varying range of returns here. So let's dive into that. So at first, when I first built out these sensitivities, I had them with just the project level returns. But then I kind of realized, well, at the end of the day, what we care about and what we focus on is actually what the return that our investors are getting. And so rather than spending a lot of time focusing on sensitizing the project returns, we should really do the net returns. And so I just added that quick toggle so that way we can look at the net returns across these sensitivity tables. But for whatever reason, if you want to go back and forth, you can do so right here. I'm wondering, by the way, if it's helpful, and it may not be, but I can actually copy the Dropbox link for this underwriting and just pop it into the chat. I'm not sure if, yeah, I think I can do that. So there's that link. If you want to follow along, if you want to actually check out the exact model that I'm using right now and playing with, I just dropped the link there. So check it out. But yeah, so let's actually go table by table, and we'll go through the sensitivities and kind of, what they mean. I mean, they're pretty straightforward, but let's just tackle the first one. So the first one is we're sensitizing IRR across terminal cap rate and annual rent growth, right? So these are the two, I'd say the biggest hot topics, or the most publicized assumptions in a model, right? It's the first question that many people ask is, oh, well, what rent growth are you using and what exit cap are you using? So I think it's really important to actually look at that. And I think investors can get more comfortable with the deal if they see the range of outcomes, and they can live with the downside, right? Obviously, everyone can live with the upside, so it's really all about the downside. So if our base case is a 5.25, and then we widen it out 75 basis points to 6, and our rent growth stays the same at 3%, then we go from 14.1 to 10.3, right? That's a big move. That's definitely a big move. So I don't want to just downplay that and say, oh, it's no big deal. That's a big deal. But when you go to 2% rent growth and the 6% cap rate, that is 8.2%, which I think in a downside scenario is still pretty healthy. And if you think about kind of the way that these metrics interact with each other, or these two variables. So for example, like rent growth could be both a reflection of real rent growth or nominal rent growth due to inflation. So if we did, for example, have rent growth due to inflation, you would assume that you would also see a pickup in the 10-year treasury yield, and then that means cap rates would generally go up as well. There's about a 70% correlation between the 10-year treasury and cap rates. So what that means is, if, for example, rent growth exceeds expectations and it has something to do with inflation, you would also think that cap rates may go up a bit as well, because inflation would cause cap rates to be higher. So then you'd be looking kind of at these outcomes. So it's kind of like, nothing just happens in a vacuum. They all interact with each other. On the other hand, you could make the argument that if rent growth is coming as a result of real growth in the area, let's just say Amazon moves in and the place is booming, there's headquarter relocations and the population is growing and all that good stuff, then you kind of have the best of both worlds. Your rent growth assumptions are improved, and your exit cap rate, the cap rate at which your income is valued at, is improved also, because people are willing to pay lower cap rates for that embedded growth that's occurring in the market, right? And so then you could find yourself growing faster and your income valued more. So it's just interesting, those dynamics. But I think generally speaking, you kind of just want to have the range of outcomes, and then just look at the one furthest in the top left corner and be comfortable with that outcome. So let's go to the one just below it, annual rent growth versus stabilized vacancy rate. So this is pretty similar to the last one, and they're actually all pretty similar. But again, we have rent growth, but now it's on the side, and then stabilized vacancy rate. So what's really interesting about vacancy rate is it generally speaking, it makes a really big impact on the numbers. And so myself and a lot of the investors I work with, they spend a lot of time scrutinizing the vacancy rate, because a lot of the time we take vacancy rate for granted, and sellers in particular will do everything they can to make their vacancy rate look as strong as possible when they're prepping a deal for sale. So a lot of times you'll see a deal for sale and the vacancy rate may be 7%, but the comps around it might be 8, 9, 10, 12. And so it's you really want to make sure that you don't just assume the vacancy rate that's in place, but really can justify it with comps in the market. Because if you look at the 7% vacancy rate, and if you go from 7 to 8 in this deal in particular, I'm noticing it's not a huge difference, only 60 basis points. But often it can have a bigger effect. So I'd have to think more about why this deal in particular isn't so sensitive to vacancy. But my guess is it maybe is due to the expense ratio, right? The greater the expenses are as a proportion of income, every individual dollar lost of income would have that much bigger of an effect on the NOI. So that's kind of just my initial thought. But but yeah, again, I'm looking at the top left corner, and that's kind of my, obviously not a worst case scenario, but within the context of these sensitivities is what we have to work with. And that's definitely a comfortable downside.
Hey, Rob, while we were, and sorry to interrupt you, a question came up that's relevant to what you're discussing right now. Or the vacancy rate, the question came in, was it economic vacancy or physical vacancy? My assumption is economic, but you go ahead and answer that one.
Right. That's a great question. And that actually has me thinking, so the answer is economic, right? Because we're in the model, we're using numbers. So my initial reaction is it has to be economic, but the nuanced answer is it just kind of depends on your definition of economic vacancy. So some people define economic vacancy as all losses, which is a fair definition, and I that's potentially my definition as well. So in this scenario, right, this would be actually the physical vacancy loss quantified in numbers, and then the total economic loss would incorporate loss to lease, vacancy, concessions, non-revenue, and bad debt, right, for a total of 9.5%. So if you want to make that distinction, you can make that distinction. But another way to look at physical versus economic is just heads and beds would be physical. So if you have 10 units, right, you would have, let's say you have 90% physical occupancy, you have 9 heads out of 10 beds. But the difference could occur where, let's say that one vacant unit just so happens to be your really deluxe expensive 3-bedroom that's $2,000 a month, and then all your other 9 occupied units are $1,000 a month. I mean, I hope I'm not being like just explaining this too much for no reason, but right, that would be $1,000 a month for your 9 occupied units, divided by $1,000 a month for your 9 occupied units, plus the $2,000 a month for your unoccupied unit. So while your physical would be 90%, your economic would actually be 82% here, or 81.8. So that's one of the definitions or distinctions between physical and economic. And then the other one would be economic, where you've got, all the losses considered. Do we want to touch on any other questions?
No, that was a good one. And he said, thank you for answering that.
Okay, cool. Yeah, and I would really appreciate if more questions came in, and I know you said you wanted to hold questions till the end, but if there are some good ones, please sprinkle them on me so I can kind of break up my just like talking at the screen. So
sounds good.
I actually, I'll go ahead and hop in there for you, Rob. If you don't mind, if we could circle back, I wrote down a couple questions for you concerning the yield on cost calculation. And I know you mentioned that you like to compare it to your exit cap. And my question is, do you also like to compare it to your going in cap, or I'm sorry, the market cap at the time of acquisition? And if so, compared to both market cap at acquisition and exit cap, is there a typical standard that you look for as far as the number of basis points within that spread between the market cap and the yield on cost?
Yeah, really good stuff. So yes, absolutely. Our biggest focus, like I mentioned, is the return on cost minus the exit cap rate, which in the development world is called a direct spread analysis or spread analysis, right? Because this is in its purest form, it's development. If I'm going to build something, right, I've got my land costs, I got my construction costs, and then I'm going to have a pro forma income for my finished product. And so let's say my yield on cost for my development deal is 6.5%, and that's great. But I'm a developer. I build it and I sell it. And so if I can build it for 6.5, what can I sell it in the market for? And so I'm looking at that development spread. In value add, it's very similar, but we aren't, we're more open to holding long term, or it might be outright in the business plan to hold long term. And so we're less reliant on that spread analysis, but it's still extremely important. So for us, that spread, if it's a more of a cash flow deal, the spread is less important, but it's still important. But what we're looking for in like a more cash flow deal is a 50 basis point spread. And in a value add deal, we're looking for anywhere from 50 to 150, just depending on the risks, right? If I'm buying a vacant property, I need 200 basis points of spread, right? Just to incorporate the added risk. And then your question about, market cap rate versus exit cap rate. We derive our exit cap rate via the market cap rate. So it's kind of embedded in that thought process or in that calculation. And I know, so a lot of people take the approach of, well, if my going in cap rate's 5.5, my exit cap rate should be 50 basis points increased to 6%, right? But we don't look at it that way at all. We really just focus on the market. So because, we don't want to get penalized or congratulated depending on whether we overpay or underpay for the deal, right? If we steal a deal, if I buy a deal off market where the market is, 5.5 cap, but I stole it for 6.5, I shouldn't project my exit to be a 7% cap rate. I'd be penalizing myself for no reason, right? The market is the market, irrespective of what I pay. So for that reason, we look at the market. Let's say the market's at 5.5 today, and then we'll typically be 50 basis points increase of the market. So we might go to 6%. But to be totally honest, that is getting tougher and tougher to do. We used to want to do 1% increase, right? If the market was 6, we'd want to exit to a 7. You're not seeing any 7s. I mean, that's not totally true. Some smaller markets, I'm still seeing people underwrite to 7% exit cap rates, but it's very, very, very rare. And in core markets, you're seeing exit cap rates with 5 caps, with 5 cap handles, more and more common. So, we have to constantly balance our need to be conservative underwriting and the need to actually be aggressive, which not a lot of people want to talk about. Everyone's a conservative underwriter, but the reality is you have to be somewhat aggressive, at least somewhere in your numbers, or else you're going to remain a theoretical investor and never buy anything. This market's hot, market's competitive. You have to find some way to get aggressive. And so, well, that's what we're seeing. We're seeing it's harder and harder for us to build in that 50 basis point spread. And so we're seeing it, 25 to 50. And yeah, that's the reality. So hopefully that makes sense. On this deal, for example, we've got, if you take these numbers at face value, which, so this is actually a really interesting test, and it speaks to the validity of the metric, right? The pricing guidance for this deal was 112 million from the broker. Ended up selling for 114, but I just kept kind of plugging in and guessing and checking until I found a price that I liked. And so 100 million I like, and it just so happens to be a 50 basis point spread on the return on cost versus the exit cap rate. And you can see it gets us to a 14% net IRR, which is a great return and an unrealistic return even to expect for a deal of this institutional size and location quality. So, but it still shows you that in order to get kind of that mid-teens return that you like to see, you need that spread to exist in the return on cost versus exit cap rate.
That's awesome. There was one more question that came in. It's related to cap rates. And I don't know if it was you, Rob, or Troy that mentioned it. Cap handle. Was that I think.
Oh, that's just, it's just slang. It's, when you say a number and it starts with like its handle, right? So if it's a 5.5 cap, it's a cap rate with a 5 handle. So that's just slang, but it's yeah, that's all I meant by that. So, we're talking mostly these days, like if you're in a really hot market like Phoenix, Atlanta, Denver, Dallas, if you're not projecting an exit cap rate, again, with a 5 handle on it, meaning there's a 5 that starts on your exit cap rate, you're just not going to buy the deal. The prices are too competitive. Everyone else is solving for 5 or 5.5 cap. So that's all I meant there.
Thanks for clarifying that. These are those little tricks of the trade that when you're talking to people, it'll make them ask the same question, and then it just makes you look smart. So thank you for saying that, because now we can use that.
That's awesome. Exactly right. Yeah, we want to make, it's important to look smart. Definitely. Very important. So yeah, awesome. Good stuff. Any other questions, or should we just kind of finish up on a few of these here?
Yeah, certainly. Let's get back to the sensitivities. And since we're jumping back into the topic, the bottom left corner is where you're putting those inputs, right? I know there's inputs in the first tab for the underwriting, but for the sensitivities is here and on the top right, correct?
Yeah. So on this page, anything in orange is an input or fair game to be an input. You don't have to do anything, but it's fair game to input. So yeah, it's a good point. So let's run through it. I almost never touch this because I just kind of leave the intervals as standard, but let's just say you wanted a wider range of outcomes on the rent growth. So you could change that to 50 basis points instead of 25. And now our rent growth is going to range all the way from 1% to 4.5%. And you're going to see a wider range of outcome there, which is very fair to do. And I forget how this even works. This one I have to, I guess it's by 1 month, or by, we could change it to 3 months. And so now we're stabilizing from 21 months to 39 months, which is really fascinating. Nobody talks about how much of an effect that this has to your deal, especially the shorter your hold period. If you have a 10-year deal, this is why I and everybody else loves 10-year deals, but it's very hard to convince someone to invest on a 10-year timeline. But the reality is, if you have long-term debt that's 10 years and you have a business plan that you want to implement in 18 months and you totally mess up and it takes 24 or 36, it's not going to materially impact your numbers. But if you have a 36-month hold deal where you want to buy it, fix it, sell it, and you're underwriting a 12-month stabilization, and inevitably things always get delayed, and it's 18 months, it's going to make a huge impact on your numbers. Huge. So here you can see this deal is not much of a lift. There's not that much happening through the stabilization period. So there's really, doesn't matter when you stabilize. So yeah, that's an interesting point. But getting that stabilization is very critical to get right when you have more of a true value add deal where you underwrite it opportunistically with a 3-year hold, which is what we do, by the way. If it's a stabilized deal, we're just going to underwrite a 5-year hold. That's the standard. But the fact that on a shorter term deal, investors either, I don't want to say want to see a refi, but because a lot of people think it's bad to underwrite a refi, and I agree. But the fact of the matter is, investors want you to refi in reality. They may not want to see that in the underwriting, but they want to see you get in and out and monetize the value creation as quickly as possible. And so the way that we do that is, instead of underwriting a refi, we just do a 3-year hold, and we tell investors that, hey, we're going to look to sell a refi just depending on market conditions as quickly as possible. But to be conservative, we're going to assume it happens in a 3-year timeline, but we're pretty confident that it'll happen sooner. Thing is, though, is when you start doing IRR calculations on a 2-year hold, the numbers get pretty crazy, right? You could get like a 30 IRR if you have the right numbers. So, and that, you don't want to set those unrealistic expectations. Because again, if you get it wrong and you don't sell in 2 years and you sell in 3, all of a sudden that 25 IRR turns into a 15. So 3 years is kind of where I've seen it gets more normal. And speaking of which, we can actually look at this next one, which actually does sensitize hold period. So, and what I'm going to do, this is fine. So one thing that's interesting is, as your stabilization timeline gets closer and closer to 3 years, it's going to unrealistically penalize the numbers. Like you can see here on a 3-year hold is 7.2 IRR, but then you're all the way out to a 12 on 10. And this is not really fair to do because you haven't even stabilized yet and you're already selling, right? So that's the issue with doing that. And so I look at that often. I look at the relationship between the stabilization time and then the hold period and make sure that I'm not, cutting it too close. And similarly, if I am modeling a refi into the model, you don't want to project the refi to happen like right after stabilization because you haven't fully created the value. And so then your refi valuation won't be as high as it potentially will be. But here you can see in terms of hold period, just generally speaking, the way that it typically works is, again, depending on the stabilization timeline and the rent growth assumptions, you typically kind of maximize the IRR in the earlier years, which could be anywhere from years 3 to 5. But typically you see it peak in one of these years, and then 6, 7, 8, 9, 10, it'll slowly drop down. And that's what you're seeing here. It maxes out in the first 2 here based on an exit cap rate of 5.25. And then it just slowly goes down, which just makes sense. So I jump to this table a lot when I'm looking at when I just want to see different returns across different years and just see like, well, does this deal make more sense as a 3-year hold? Does it make more sense as a 5? Sometimes people say, well, should we do a 4-year hold or a 6-year hold? And I don't like that just because people aren't used to seeing that. So it adds complication. So I just want to keep it simple, 3 years or 5 years, and even 10 years, I think. And I'd, be happy to hear from people listening, but I just feel like telling someone it's going to be a 10-year deal, I think that scares off a lot of investors. So it's just probably not in your best interest to do that. Sometimes it may be in the deal's best interest to hold it for that long, but I think going in with that business plan is challenging.
Hey,
That's
Rob.
another reason why you just have to know your investors, because there's definitely investors out there looking for a nice, safe 10-year hold, and they're willing to trade that for a lower yield. You know what I mean? So, not to contradict or just playing devil's advocate. And there's definitely investors out there that are looking for those returns, man. That are looking for that kind of investment too.
Yeah, definitely agree. Yeah.
And Rob, I was going to mention in terms of not related to your question, and I did invest in a 10-year deal because it was with my self-directed IRA. So those funds I'm not going to touch until later. So like Tim said, all related to the audience. In terms of like your process, because this is a way to, once you've inputted all your numbers and sort of sharpen your pencil, now you're really stressing and assessing the investment. I just wonder where, in terms of, when are you looking at this particular tab in chart in the process of you underwriting and acquiring a deal?
So like you said, for sure, it all starts with the inputs tab and getting the numbers in the model before we can play with it, of course. So I would say the way that we typically run our process is there's a preliminary underwriting, and then there's there's further investigation that needs to be done, which usually starts with rent comps, because that's one of the hardest things to justify. Like, for example, expenses, those are, I don't want to say easy, but those are more straightforward. They're just more typical, and you can use per unit rule of thumb. But with pro forma rents, they're so important to get right, and they require a lot of effort to do so, because you have to spend a lot of time comparing apples to oranges, because when you're comparing comps, they're not identical unless they're literally at your property. But if you're comparing outside comps, you have to make sure that the finishes are comparable to what you're going to make your finishes. You have to make sure that the other income schedules match up, and that, one deal isn't all bills paid and the other deal is billing back for water and sewer, to make sure that or you have to adjust for whether or not the deals have 8-foot ceilings or 9-foot ceilings. So without going too far into rent comps, basically that's kind of the next step. And once that's in place and, we feel good about the numbers, then I'll start looking at some of the sensitivities, because the sensitivities will help us dial in our price. And so, we might come in with an initial offer and then a subsequent offer, And so we need to make sure that our price makes sense. And the biggest one, if we're to skip ahead, which I think we should, is really on the exit test. That's the biggest concern and the biggest place I want to focus on to make sure that the downside is covered, because you can have deals that look good or bad on an IRR basis, and they can pass or not pass the exit test. And so I just want to run through quickly the exit test. So and hopefully some on the call are already familiar with it, so we can kind of go quickly on it. But basically the idea of the exit test is you want to know that when you have your loan maturity, that you are not in a position to where you have to fire sell the asset, right? So, and the way that you avoid a fire sale is you have access to debt financing. And the way that we stress that is we look at different shocks: operational shock, capital market shock, and then this one, which is brutal, which is the both shock that very, very few deals pass. That's how we actually look and stress the deal and say, well, in a worst case scenario where our revenue is lower than we expected and cap rates and interest rates are higher than we expected and leverage is lower than we expected, can we still get a loan to refi out our existing loan? And so there's really a few ways to help mitigate this risk. Number one is your going in loan amount. You can have your going in loan amount low enough to actually account for this risk, right? Because if you go in at 60% LTV, then it's pretty well understood that you'll likely be able to refi out of that loan. But if you go in with a high leverage bridge loan and that has a 36-month maturity, that's where this becomes critical, right? And so in the 10-year permanent debt space, this exit test isn't that critical, because if you have 120 months to pay off your debt, rent growth over those 120 months is going to be happening, and your value is going to be increased. So you're going to be fine, most likely. Agency lenders still do perform this exit test, and that's how they actually determine how many years of interest only a loan can handle. Is they forecast out the maturity, and they need to see, okay, well, we need to have X amount of years of amortization so that we pay down the loan balance so that we can actually pass the exit test, and actually they can exit out of that loan successfully. But for us, the main concern is the bridge loan situation, where we do go in at a high leverage, and we're really, because if you think about, if you're going into the deal at 80% loan to cost and you plan on refining out at 80% loan to value, that means you need to have at least created enough value through your capex that your now property is valued at what your purchase price plus your capex is equals. So that's, kind of went a little ahead there further, but that's to answer your question. I mean, really, when we're diving in, that's what we really look at on the bridge loan deals is this exit test on the sensitivity side. And that's kind of, I'd say, more towards the end of our process.
No, that's awesome. Thanks for explaining that, for sure. And we've gotten a lot of questions. I know we wanted to hit up the waterfall as well. I don't know that I'll kind of leave it up to you. Do you want to go to questions? Maybe hit up the waterfall. Rob, what do you prefer?
Let's just see if we can quickly answer some of the questions coming in, and then the waterfall hopefully can be quick.
Okay. The first question that we haven't touched on, or Troy, you go ahead.
No, I was just going to say, since we're on this exit test assumption tab here, we had a couple questions coming in regarding the operational shock. Would you mind just kind of diving a little bit into the operational shock and the inputs that go into it?
Yeah, and these shocks you can make them your own. So the way that I define the operational shock is actually by reducing the projected revenue for month 36 by 10%. And then here I just have this, which is the resulting NOI decline. So, right, because you've got expenses. So if your expenses stay the same, but your revenue goes down by 10%, you're going to have a bigger decline in NOI. So that's the operational shock, right? It assumes that your cap rate, your interest rate, everything stays the same in the world, but your revenue goes down 10%. And that's the shock. And that may not be enough for you. You might want to do 20%. And that would actually cause the both scenario to fail here, as you can see. The capital markets shock is now not touching revenue. So you can see the base case NOI is 6.6 million. In the operational shock, that's down by 18%. In the capital market situation, the NOI is the same as our base case. We're not messing with the NOI, we're messing with valuation. So what we do is we're saying, well, you thought you could get an 80% LTV loan. Well, now you're only getting a 75% LTV loan. And your interest rate is increased by 25% than what you thought. And your exit cap rate is 15% greater than what you thought. And that's where your values hit because, and we actually don't have enough space to show. So the base case loan amount is 107 million, but you can see in the capital market shock, it's down to 87 million not because of NOI change, because it didn't. It's because the cap rate at which the refi is valued at and the leverage that the refi is executed at is lower. So that's how those two shocks work. And then the both just combines the scenarios. Now we have the lower operational shock NOI and the capital markets valuation metrics of higher interest rate, cap rate, and lower leverage. And so you can see it really hammers that loan amount down to 71 million. Fortunately, on this deal, the going in leverage is only 65 million. And so it actually does pass the exit test on a 36-month basis.
Cool. Okay, Ken, hopefully that answered your question on the operational shock. It's really the revenue. So the rent is what you're going to be sensitizing there, even if you're able to increase the NOI by decreasing expenses initially, you're still going to be testing the rent there.
Rob, here's an easy one. This is tied to the rent comps because the conversation we were having a little bit earlier. What's your preferred low place to go get rent comps? And do you put a lot of weight on your sequence shopping or online services?
So we use CoStar for the most part, and CoStar does a good job, but it depends on which market you're in. It can often be just flat wrong, or it can just not have all the information that you need. And unfortunately, that causes you to do a lot more work. And like you said, secret shopping, Googling, apartments.com is good. Calling individual properties is really my favorite way to get information, because and when I'm either in person or on the phone, the biggest thing that I'm focusing on when I'm secret shopping is the other income schedule. I want to know how much does it cost for me to move in? What are the costs every month other than rent? Do I have to pay water? Do I have to pay internet? Just kind of what are all the built-in costs? So I know what the true rent burden is, and then I can compare fairly apples to apples. So I wish it were easier, because the only service that I know that actually includes some of that other income information, I believe, is ALN. So, but we don't use ALN very often.
Cool. Richard, I hope that answered your question. I'm scrolling up to some other topics. David asked about your developmental spreads that you're seeing. I'm just going to read it out loud. What are some of the typical development spreads you're seeing for a 15% value add increase on EGI, or do you focus more on yield on cost?
So yeah, 15% increase in EGI is a very fairway value add. That's like a light value add. And I'd say what we're seeing in terms of what deals are actually trading at and pricing at, I would have to take a guess that development spread is pretty close to zero on average deals that are 15% increase in EGI value adds, which is just indicative of how aggressive the market is. So that's kind of, I'd guess, where we're seeing spreads at typically. But for a 15% increase in EGI like that, we would want to see, at least a 50 basis point increase, or a spread rather, or, preferably 75. 100 would be a lot to ask for, depending on the quality of the market. So the thing about it is, these spreads don't factor in growth at all, right? They're an untrended, stabilized yield on cost. And so when we say untrended, there's no rent growth assumption built into these return on cost metrics. So the reality is, if you're buying in a super hot market where there's tons of growth, having actually, a 25 basis point spread between your return on cost and your exit cap rate may not be the end of the world, because if you're growing rents at 3, 4, 5% per year, that 6.25, or, that 25 basis point spread is going to turn into 50, 75 basis points over time through growth. So the better area you're in, the lower spread you can accept.
David, I hope that answered your question. Rob, we got another 10 minutes or so. Do we want to hit up the waterfalls and then we'll get back to the questions?
Yeah. Let's just go through it quickly, and then we'll stop sharing the screen. We'll go gallery and do that. So the waterfall tab is really for the partnership on the equity side of things. And, we could spend an hour on this tab, or we could spend 5 minutes. I'm going to try to do 5 minutes. The point of this here, without getting actually into the nitty gritty or the math of how this is all calculated, this is really just for you to input your promote structure and model out what net returns look like. So I'll just I'll walk through this example. This deal has an 8% preferred return. And so the way that these tables work typically is based, so up to 8%, there's a 0% promote, right? That makes sense because it's a preferred return. So up to 8%, there's 0 promote. Now the next tier is up to 18%, there's a 30% promote. And that's very common and standard, what people are used to. And then there's that tier, that additional tier of return where the promote increases. So now first it was up to 18, and now it's 18 and beyond is a 50% promote. So that's the second tier promote for the sponsor. So if the sponsor is hitting it out of the park and they're delivering an 18% IRR net to investor, now for all cash flows above that, they're entitled to 50% of those cash flows. So as an investor, this can be viewed as a good thing, a bad thing, because on the one hand, your sponsor is incentivized to outperform, but on the other hand, this could incentivize them to want to hold the property for a shorter period of time so that they can try to pump up the IRR, potentially to the detriment of the LPs or their desire to hold longer term. And the other point is, this additional hurdle rate is often not advertised kind of like front and center. I don't want to say it's like a hidden fee, because it's not. It's definitely there for people, but people kind of just sneak it in. And like 3 years ago, 18% was standard, and then 15% became standard, and now I'm seeing a lot of 13%, where, to clarify, where it becomes a 50-50 split of the cash flows above 13%, which that's very expensive. And I would just pay attention to that and take a look at it, because depending on how you're penciling the deal, it can have an impact. Obviously, the more the returns are greater than that additional hurdle, then the more impacts your net returns. If the deal never even makes it to 18, then don't even worry about this. But this can have a big impact on your returns. And so, you just want to make sure that you incorporate that into your waterfall. So yeah, I think that's really it. If you are interested in modeling a deal with a preferred return type hurdle versus an IRR, you can do that here. And so just to clarify, the way that the IRR hurdle works is, you can look at it in tier 1. Basically, it performs an 8% IRR check. And so there's no promote until investors have received an 8% IRR. So the way that works is, in this situation, investors put in 40 million, So 8% of 40 million is 3 million. So they're owed 3 million for the first year. They were only distributed 3 million in this example. So what actually happens is that delta gets added to the investor's capital account. So now it's as if the investors invested 40 million plus what they weren't paid on that 8% for year one. So that transfers over to the year two beginning period capital account. So now the 8% is calculated on that increased capital account. And so that's how the compounding mathematics works in calculating this 8% IRR. So then what happens is finally in year five in the tier one, we distribute 41.8 million, which is just enough to get investors to their 8%. So now investors have successfully put in 40 million. They've gotten their cash flow over time. Then they got just enough money to get the 8%. Now there's 25 million remaining of distributable cash proceeds from the sale, which now are split at the 70-30 in the tier two. So that is how the IRR hurdle works. However, if you are in a preferred return structure, I've got it. This is not very clear, but it's actually a separate waterfall that is hidden. And so let's see if I can do this. I have to go to here, unlock the sheet. There's no password to unlock. You just have to hit unlock. And then unhiding that reveals the preferred return structure waterfall, which works differently, where the capital account does not so basically the cash flows are promoted. So you can see that the promote actually kicks in year two, where investors don't get all their money back prior to the 70-30 split happening, because in year two, the 8% cash flow preferred return is met, and then the promote kicks in. So if you want to look at both of them, those are the options, and then that'll change the IRR calculations. And, it doesn't really affect the returns very much. So if we look at this 18% IRR the IRR calculation, right? Investors get a 14.1. Now, if I change it to preferred return, it's probably going to go down just a tiny bit. Nope, wasn't even a big enough deal. So it doesn't even change the returns. So why do you care? The answer to that is downside protection. The reality is, if your promote as the sponsor is subordinate to the investors getting all their money back, that's just more protection for the investors, right? The investors need to get their minimum 8% return and all their money back on a cumulative compounded basis. And then the sponsor sees promote compensation. So while in a base case scenario, the difference in structure may not really result in a difference in return, but in the downside, it's going to protect the investors, because they're not going to have paid any promote along the way. And then if for whatever reason the property sells at a loss, there's no refund of promote, right? So that is, I guess the last thing I'll really comment on the waterfall. Otherwise, it's just there for you to model your partnership. And, another time we could kind of dig in more into how it works and other structures. So yeah, hopefully that was helpful. And I'd love to, stop sharing my screen and just go into gallery view and hear from everybody.
Absolutely. Thanks, Rob. That was great. I feel like we got the key to a secret door there with that hidden space. So thanks for sharing that tidbit. I know for me, I'll be going back to this video multiple times to just review it. And I know the folks in this room will be doing the same. Troy, you want to hit up the remaining questions that came up that we haven't touched on?
Yeah, let me see here, scrolling through. A question here. Any reason why occupancy stress does not show for all years you intend to hold? I'm guessing that was on the sensitivity analysis tab.
Yeah.
Okay.
Yeah. Basically, the question is, if we're looking at a metric such as break-even occupancy for the year zero, which would just be day one, essentially year one, year two. The idea is, the reason why we don't look at it for all the way out to year 10 is because if year one and year two look good, then there's no reason why the subsequent years would look bad, right? Underwriting, unfortunately, doesn't reflect reality, where in reality, it's true, deals do go up and down, and you have years where there's negative rent growth. But in the model, we underwrite things very linearly, right? We just underwrite a steady 2% growth over the whole term. So that just means if the deal looks good from a break-even occupancy in year 2, then it's just based on the model, not in reality, but just based on the model, 3 and beyond are going to look good as well.
Got it. Okay, we have another question here. So it sounds like the choice between IRR and preferred return could be driven by the market. Which choice is preferred by most investors? Does this vary by geographic region?
That's a good question. I don't know if it varies by geographic region. I think it is driven by the market and kind of by the, in a way, sophistication of the investors. From my experience, the more institutional type investors, they take a very hard position and say, I don't want you to make any money on my money until I've gotten all my money back. So that's just how the private equity world works. And I can't blame them. When I first was slapped in the face with that, I thought, oh my gosh, what do you mean I can't make any money? I have to wait until we sell? It's crazy. And it was very surprising to me. But as I learned the structure and understood it better, I thought, wow, this is actually very elegant and I appreciate it and I understand it. The issue with it though is, like we discussed, it incentivizes the sponsor to sell. And like someone on the call mentioned, that there are long-term investors out there and they want to be in a deal for the cash flow for potentially 10 years. A sponsor who is subordinate to a return of capital is just not going to stay in a deal for 10 years, right? They're not going to want to be in a deal where they don't make any money and they're just sitting on this promote that if they sold, they could make hundreds of thousands of dollars. That's just, sponsors don't do that. And the institutional or the private equity world, they recognize that, but they're in it for, number one, the downside protection, and number two, they're okay with the shorter turnarounds. They're okay with kind of the churn and burn because that's what they're in the business in, right? A more passive investor, they want to set it and forget it. So you may want to find a sponsor that has a long-term outlook or has a structure that is conducive to the long-term outlook. Whereas, the private equity guys, they're fine with getting their money back because they've got the next deal that they can put it back into and roll with it.
Yeah, that's great. That's awesome, man. I have a couple questions that kind of stem from that. However, I know we're past the top of the hour, so I do want to quickly, before you have to hop off, I want to give the floor to anybody on the call that has questions for Rob before we let him go. Please feel free to speak up. No questions, huh? Okay.
I don't have a question, but thank you, Rob. I'm learning this. I'm sorry, I'm doing my daughter's hair. I'm learning the underwriting process, and that was very, very informative. So thank
Awesome.
you.
Great to hear.
I have a quick question. I know, Rob, your stabilization period is one of those sensitivity data that you talked about before. And it looks like when I received your original model, it looked like there was a formula in there. And then I go ahead and change like from 24 to 12 months, whatever, just to change the stabilization period. And that formula disappears. So does it affect the overall output that I get in your model, or is it okay now that that formula is no longer there in terms of my output?
Great question. So that formula is just a placeholder, and it's meant for you to actually overwrite it like you did, right? So if the formula kicks out 12 months, but you think the right number is 14 or 16, then you just overwrite that formula and go with your number. It's just, like I said, a placeholder so that there is some number there, and there is some logic to that placeholder. I'd have to pull it up to see exactly what the logic is, but it's basically based on the number of units you want to renovate, and then it's divided by a certain amount of months or something like that. So, we always change it. It's just there to start, and then we change it to whatever we think is reasonable. And similarly, unless you unlock a tab, any cell with a formula that you actually have the ability to change, it's okay to change, right? The cells are locked. The cells that need to be locked are locked. The cells that are open to be changed, you can change. It's all safe. But the second you unlock a tab, right? It's all fair game, and you might make a mistake. So just be careful when you do unlock tabs that you don't accidentally, change something that's not supposed to be changed.
Okay, cool. Thanks so much. And I guess the same thing would apply for the number of units to be renovated at, just like you just explained, because in that it just calculated the total number of units in the project, of course. And you can always, if you don't wish to renovate everything, you want to leave something on the bone for somebody else, you can change the number in there in terms of the number of units to renovate, correct?
That's exactly right. Yeah, if it's partially renovated or your plan is just to do 20% and prove it out, then you can change it.
Okay, great. Thank you so much.
Awesome. Last call, folks, before Troy closes us out. I know that some of you have asked about the recording. I will be sending an email to everybody that registered with a link to the recording, so don't worry about that. So if no questions, and Troy, I'll hand over the baton to you for closing.
Yeah, we actually just have one last question for you, Rob. Is it possible with additional questions for anybody to reach out to you via email or any other type of platform? Would you be open to that?
Yeah, I try my best to get back quickly to people on anything, whether it's underwriting or not. My email is rob@lonestarcapgroup.com. I'll just pop it into the chat. I'm not inviting everyone for me to underwrite your deals, but like I said, I try to get back to people with answers, but no, I can't, underwrite for you. I've asked that, of course, and I, have to say, hey, this is my business. I can't do this.
Well, if the price is right.
Right.
Awesome. Well, yeah, man. That was really great stuff tonight. I know I jotted down a ton of other questions. We'd love to have you back sometime. I could pick your brain for hours with this underwriting stuff, but you dropped a lot of knowledge, a lot of gems tonight. I found a lot of value, and I'm sure, and even based on the comments that we're seeing in the chat box, a lot of the audience here has as well. So we really appreciate your time, man. And thanks again for joining us. And thank you to everybody in the audience there for joining us tonight. And with that, we'll wrap it up. Thanks again.
Thanks, Rob. Thanks for coming.
Yeah, thank you so much.
Thanks, Rob. Thanks, organizers, too. Be well.
All right.
Thank you, Rob.
Thanks, Rob.
Thanks, Rob.
Have a good night.